Hello and welcome to Connected With Latham, where we discuss ideas, legal developments and business trends shaping the global economy. I'm Tom Evans, a private equity M&A partner in Latham & Watkins' London office. In this episode, we discuss IPOs, dual-class shares and whether new structures present opportunities for private equity. I'm joined today by a fellow partner from the London office, Chris Horton. Chris has a broad range of experience advising on IPOs, secondary offerings, and M&A transactions by listed companies. Thanks for joining, Chris.
Thanks so much, Tom. Very good to be here today.
I'm interested, Chris, to talk about the piece that you co-authored in Latham & Watkins' PE Views titled Exploring IPOs with Dual-Class Shares, Emerging Possibilities for PE. Before we get into the detail, can you tell me what we're seeing in the market here in London and in the US?
Yes, of course. So listings of companies with dual-class share structures are increasingly common, and they're designed to give certain owners, usually the founder, employees, but sometimes also pre-IPO investors, enhanced voting rights over other public shareholders. And they are increasingly common in the US markets, particularly in relation to tech company IPOs as they go public.
And dual-class share structures, are we seeing those in Europe too, Chris?
Yes, we are, increasingly so. The UK, for example, has now seen several dual-class share structures. For example, on the IPO of the Hut Group, on the IPO of Deliveroo, and the recent direct listing of Wise. So these deals all had some sort of special share or a B share structure designed to give enhanced voting rights to the founders. And as the UK is keen to increase the marketability of UK listings following Brexit, we anticipate that dual-class share structures will be featured on more and more London tech listings in the future. So it's a development really that is designed to benefit the founders of growth companies seeking to retain a greater governance role post-IPO.
Interesting. So dual-class structures. Can you explain, Chris, exactly what we mean when we're talking about that?
Of course. So basically, you have two classes of shares. One has enhanced voting rights, which gives the ability for the founders and other pre-IPO shareholders to maintain voting control of the publicly listed company through holding shares with enhanced voting rights. These often have a ratio typically of something like 10-1, although this does vary depending on the nature of the transaction. And then the public shareholders have a lesser degree of voting rights.
And why is that a good thing? What purpose are we serving, Chris?
Well, like all things, Tom, two sides to every argument. But from the founder's perspective, they can concentrate on the company's long-term strategy, growth and performance without having to keep one eye on short-term targets and the risk of shareholder activism while the company is in the high growth phase. And another commonly cited benefit is that founders have control over takeover attempts and other key decisions of the company. And you can imagine if you're a founder of a company and you've got a lot of your wealth and energy tied up in that company, you would want to not cede control at the time of IPO. And it's like a nice halfway house between being a private company and a public company.
Right, interesting. And what's the other side of the argument, Chris?
Well, if you're a general shareholder in a company, people will say, particularly in the UK, some of these sort of traditional IPO investors, long-only funds and the like, they will say that the concept of dual-class shares goes against the UK principle of one share, one vote, which has long been seen as a core bedrock of investor protection in the UK. So founders with enhanced voting rights could dominate decision-making with little or no representation on policy or strategy for those that provided much of the company's capital, which contributes to an erosion of accountability. And it could also give rise to conflicts between entrenched founders and management and other shareholders.
Earlier on, Chris, you mentioned that our US colleagues are familiar with these structures or more familiar with these structures than we are here in Europe. What's been the experience of our colleagues in the US?
Well, they've been much more prevalent in the US on IPOs. So if you think back to some of the larger, more famous IPOs in the last 12 months, Airbnb, ZoomInfo and Peloton all featured dual-class shares. And in the US, they do demonstrate a pathway for investors to take a portfolio company public whilst allowing founders to retain control in the listed company. They're particularly common in the venture-backed tech space in the past few years, and basically very popular with founders to protect them against hostile takeovers and activist shareholders.
Chris, you've spoken a lot about founders. today. We're here talking about private equity investors and what they should be watching out for. How's it relevant to our private equity listeners?
So where they're invested alongside founders, they should just be aware that founders may be asking to get dual-class shares and enhanced voting rights post-IPO, which might mean that the private equity house has potentially lower voting rights than the PE founder. Currently, the FCA in the UK are consulting on a new regime that actually would allow listings of dual-class share companies in the UK on the premium listing segment. Currently, they're only allowed to list on the standard listing segment. So examples there have been the Hut Group, S4 Capital, Deliveroo and Wise. But the new consultation is going to allow founders, but only founders, so not PE shareholders, to be able to have enhanced voting rights, but only specifically for two things. One is to block the removal as a director, and the other one is to give enhanced voting rights after a takeover they don't approve of. So there would be potentially limited dual-class voting rights available in the UK on the premium listing segment.
Is it permitted, or are dual-class voting structures permitted anywhere else in Europe, Chris?
Yes, they are actually. So it's only the UK with its premium listing segment that does not permit dual-class share structures. You could, for example, have dual-class structures in Amsterdam on Euronext, and also since 2020 they have been permitted in Italy, according to our Italian colleagues.
And when do we expect the UK to follow suit?
So the consultation is closed, and we, along with a number of other firms, made a contribution to that. Personally, I'm supportive of dual-class share structures being permitted on the premium listing segment. The advantage of the premium listing segment is that it really is the gold standard for London listings, and you can also benefit from FTSE indexation. We would hope to see the new rules come in place in the new year, so timely for the 2022 IPO pipeline.
Presumably the hope is that a host of tech companies line up for IPOs in the coming years, Chris. Those dual-class share structures may well help lure some of Europe's best founder-driven businesses to the London market and ensure that Britain regains its advantage in the global markets, perhaps.
Well, that certainly is the plan. And, in all seriousness, when you look at the composition of the UK stock market, somebody recently commented that it looks very 19th century. And so if London is to remain a global financial centre and be competitive with the rest of the world, I think it's a good thing that dual-class share structures are permitted, and it would be great to see an increasing number of technology and healthcare life sciences with strong founders coming to list in London.
It's been great speaking with you, Chris. Thanks very much for joining me today to discuss IPOs, dual-class shares, and whether those new structures present opportunities for private equity.
It's been a pleasure, Tom. Thanks so much for having me on the podcast.
Thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you listen to podcasts. If you'd like more information about the topics in this podcast, please email us from the links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.